There's a $25,000 tax deduction hiding in your W-2 right now, and the deadline to claim it is 11 days away. If you earn tips as a server, bartender, barber, driver, or any one of 68 eligible jobs, you could be sitting on one of the biggest tax breaks of the decade, and most people are getting it wrong. Here's what this video is going to do for you. By the end, you'll know exactly how to claim up to $25,000 off your taxable income, step by step. You'll know if you qualify. You'll know what form to use. You'll know the 3 mistakes that could cost you thousands, and you'll have a screenshot-ready checklist to follow. Quick note, I'm not a financial advisor. This isn't personalized tax advice. It's what the data shows and what the math says. Always do your own homework before making any money moves. Now here's why this matters more than you think. 3.5 million people have already claimed this deduction this tax season. That's according to the latest Treasury data. And the average refund right now is sitting at about $3,500, up nearly 11% from last year. Part of that jump is because of this exact deduction. You've probably heard the phrase, no tax on tips. Sounds amazing, right? Like every dollar of your tips is now tax-free. That's not what's happening. What actually happened is that last July, a law called the One Big Beautiful Bill Act created a new tax deduction, not an exemption, for qualified tip income. The difference between those two words matters a lot. An exemption would mean tip income is invisible to the tax code. A deduction means you subtract it from your taxable income before the IRS calculates what you owe. Your tips are still reported. They still exist on your W-2. You still owe payroll taxes on them. But the federal income tax part, that's what this deduction removes. And here's the part that catches people off guard. Mandatory service charges. Those automatic 18% gratuities your restaurant adds for large parties don't count. The IRS says those aren't voluntary tips. They're classified as wages. So if a chunk of your tip income comes from service charges, that portion gets zero benefit from this deduction. This is one of those details that could cost you hundreds of dollars if you get it wrong. And it gets more specific than that. So let's break this down properly. I'm going to walk you through the 5-step tip deduction checklist. Follow each step and you'll know exactly where you stand before you file. Step 1. Confirm your occupation is on the list. This is the first gate. If your job isn't on the IRS list, nothing else in this video applies to you. The IRS published a list of 68 occupations across 8 industries. These are jobs the government recognizes as customarily and regularly receiving tips before December 31st, 2024. Food and beverage covers the obvious ones: servers, bartenders, baristas, bussers, hosts. But it also includes food runners and dishwashers, which surprised a lot of people. Hospitality covers bellhops, valets, housekeeping staff, doormen, and concierge workers. Transportation includes rideshare drivers, taxi drivers, airport shuttle operators, and even water taxi operators. Personal care covers hairstylists, barbers, nail technicians, massage therapists, and tattoo artists. Gaming covers casino dealers, slot attendants, and some cage cashiers. Entertainment covers tour guides, coat check attendants, and ushers. Now here's who's not on the list. Healthcare workers, performing artists, athletes. These fall under what the IRS calls specified service trades or businesses. Even if patients or fans tip them, they're excluded from this deduction. So step 1 is simple. Go to the IRS website, search for the tipped occupations list, find your job. If it's there, you're through the first gate. Check the box and move to step 2. Step 2, make sure your tips are qualified. Not every dollar you receive counts. The IRS defines qualified tips with 3 specific conditions. All 3 have to be true. Condition 1, the tip has to be voluntary. The customer chose to leave it. Nobody forced them. Mandatory charges, automatic gratuities, negotiated fees, none of those count. Condition 2, the tip has to be in cash or a cash equivalent. That includes credit cards, debit cards, checks, gift cards, and payment apps like Venmo or Cash App. What it does not include is cryptocurrency. If someone tips you in Bitcoin, that doesn't qualify. Condition 3. The tip has to be from a customer or through a valid tip pool. Tips your employer pays you out of revenue don't qualify. But shared tips through a legitimate pooling arrangement, those do. Let me give you a real scenario. Imagine you're a server at a busy restaurant. Friday night, you make $300 in credit card tips and $50 in cash. Saturday, your restaurant hosts a private party and adds a mandatory 20% service charge. That's $200 distributed to the staff. That Friday money, all qualified, every dollar. The Saturday service charge, none of it counts for this deduction. Over a full year, that distinction could mean thousands of dollars of difference in your deduction. Write that down, it matters. Now, step 3, check your income against the limit. The full $25,000 deduction is available if your modified adjusted gross income, that's your MAGI, is under $150,000 as a single filer, or under $300,000 if you're married filing jointly. Now, if you're thinking, I definitely make less than $150,000, you're probably fine. Most tipped workers fall well below this threshold. But for those earning closer to the line, the phase-out math is important. Above those thresholds, the deduction shrinks. For every $1,000 you earn over the limit, you lose $100 of the deduction. Let me show you what that looks like. If you're a single filer earning $160,000, you're $10,000 over the limit. That costs you $1,000 of deduction. So instead of $25,000, you get $24,000. At $175,000, $25,000 over. That's a $2,500 reduction. Your deduction drops to $22,500. At $400,000, you're $250,000 over the limit. The deduction is completely gone. For the vast majority of tipped workers, this limit won't be an issue, but it's worth checking. And coming up in a minute, I'll show you a real example of a server who saved $4,400 with this deduction. But first, let's finish the checklist. Step 4, get the right form. Now here's the part most people skip. Don't skip this, because if you use the wrong form, you don't get the deduction, period. This year, the IRS introduced a brand new form called Schedule 1A. It didn't exist before 2025. You won't find it in last year's tax software. It's completely new. Schedule 1A is where you claim the tip deduction, the overtime deduction, the auto loan interest deduction, and the senior bonus deduction. All 4 of the new OBBBA deductions for workers go through this one form, and it feeds directly into your Form 1040. Now here's where it gets tricky. For tax year 2025, your employer was not required to separately report your qualified tips on your W-2. The IRS gave employers a full grace period because the law was signed halfway through 2025. Most payroll systems weren't ready, so your W-2 might not break out your qualified tips the way Schedule 1A needs. Box 7 on your W-2 shows your Social Security tips, but it might not separate voluntary tips from service charges. That means you may need to do some homework. If your employer tracked your cash tips separately, ask them for that number. If they didn't, you'll need your own records. Tip logs, bank deposit records, payment app transaction history. Here's the good news. The IRS says for 2025, employers can use any reasonable method to estimate qualified cash tips. And if you reported tips directly using Form 4137, those count too. But the burden of substantiation is on you, the filer. Keep your records, keep your receipts. This is your money. Step 5, file before the deadline. This one sounds obvious, but let me put it in context. 3.5 million people have already claimed this deduction as of early March. Nearly half of all filers this season have claimed at least one of the new OBBBA deductions, tips, overtime, or the senior bonus. But millions more haven't filed yet, and the deadline is April 15th. If you can't file by the 15th, file an extension using Form 4868. That gives you until October 15th to submit your return. But here's the key. An extension to file is not an extension to pay. If you owe taxes, you still owe them by April 15th. The extension only delays the paperwork, not the payment. That's your 5-step checklist. Screenshot this right now. Save it. Share it with anyone you know who earns tips, because most people don't even know this exists. Now let's talk about the real money. Let's walk through a specific example. Meet our animated friend. She's a restaurant server. She works full-time at a popular sit-down restaurant. Last year, she earned $20,000 in qualified tips, all voluntary, all from customers, all cash or credit card. Her total income from wages and tips brings her modified adjusted gross income to $85,000. That's well under the $150,000 limit. She files as a single filer. She takes the standard deduction of $15,750. That puts her taxable income at about $69,250. And now she also claims the full $20,000 tip deduction on Schedule 1A. Her taxable income just dropped from $69,250 to about $49,250. At the 22% federal tax bracket, that $20,000 tip deduction alone saves her $4,400. $4,400. That's not theoretical. That's not a projection. That's money back in her pocket when she files her return this month. And notice what happened there. The tip deduction stacked on top of the standard deduction. She didn't have to choose between them. She got both. For someone maxing out the deduction at $25,000, they'd be shielding over $40,000 from federal income tax. That's a massive amount of protected income. Now let's run another example because I know not everyone is in the same bracket. Say you're a bartender earning $45,000 total with $15,000 in tips. You're in the 12% bracket. That $15,000 deduction saves you $1,800. Not as dramatic as $4,400, but $1,800 is still a car repair, 3 months of groceries, or a solid emergency fund starter. What about a rideshare driver reporting $10,000 in tips at the 22% bracket? That's $2,200 saved. The point is, the math works at every level of tip income. Whether you're making $5,000 or $25,000 in tips, this deduction converts directly into dollars saved. Now here's the common mistake I see everywhere. People hear no tax on tips and they think all taxes on their tips disappear. Every penny, tax-free, no strings attached. That's not true. And this misunderstanding is costing people in two ways. First, this deduction only removes federal income tax from your qualified tips. Payroll taxes, Social Security at 6.2% and Medicare at 1.45%, still apply to every dollar of your tips. Those come out of your paycheck regardless. Second, your state might still tax your tips. Some states automatically conform to the federal deduction, others don't. If you're in a state with income tax, check whether your state adopted this provision. And here's the other thing nobody mentions. About 37% of tipped workers earn too little to owe federal income tax in the first place. Think about that. If your total income is low enough that the standard deduction already wipes out your entire tax bill, this new deduction gives you nothing extra. You can't deduct below zero. So if you're earning $20,000 total and your standard deduction is $15,750, you're only paying tax on about $4,250 of income. The tip deduction might help with that small amount, but it's not going to produce a big refund. This is why some analysts call this provision better for middle-income tipped workers than for the lowest earners. It's designed as a deduction, not a refundable credit. If it were a credit, lower earners would benefit more. But that's not how the law was written. Does that mean it's useless? No. For millions of workers in that sweet spot, earning enough to owe taxes but under the phase-out, it's a real, meaningful tax cut. The average benefit for those who qualify is about $1,300. And for higher-earning tipped workers in the 22% bracket, it can be multiples of that. Now I want to talk about how to set yourself up for even bigger savings going forward. And coming up, I'll show you exactly why 2026 is going to be easier than 2025, and one conversation you should have with your employer this month. This deduction runs through 2028. That means after this filing season, you've got 3 more years to use it. But 2026 is going to look different. Starting this year, 2026, your employer is required to separately report your qualified tips on your W-2. The grace period is officially over. No more estimating, no more reasonable methods. The new W-2 will have a dedicated field for qualified tips and an occupation code. This is actually great news for you. It means less guesswork, less record-keeping stress, and a cleaner path to your deduction next year. But here's the thing. If your employer doesn't update their payroll system, they could face penalties of $60 to $680 per incomplete W-2. And if your W-2 doesn't include the right fields, your deduction could get delayed or flagged. So talk to your manager or your payroll department this month. Ask one simple question. Are you set up to separately report qualified tips for 2026? If they look confused, send them to irs.gov. The guidance is published. The form revisions are coming. They need to be ready before the end of this year. You're not being pushy, you're protecting your refund. Now let me put the 4-year picture in front of you because this is where it gets exciting. If you earn $15,000 in qualified tips every year and you're in the 22% bracket, that's $3,300 saved per year. Over 4 years, 2025 through 2028, that's $13,200. $13,200 from one deduction that most people scrolled right past. Now imagine you put that savings to work. If you invested that $3,300 every year into a broad index fund averaging 8% annual returns, after 10 years you'd have over $47,000. That's the power of knowing the rules. But here's the reality check. This deduction is temporary. It expires after 2028 unless Congress decides to extend it. There's no guarantee of renewal, so the window is open right now. Use it while it's here. Let me leave you with 3 moves to make today if you haven't filed yet. Move 1. Pull up your W-2 and look at box 7. That's your reported Social Security tip income. Cross-reference it against your own records. If you track tips in an app, a notebook, or your bank statements, dig those out now. Move 2. Download Schedule 1A from the IRS website or open your tax software and make sure it's applying the deduction. Look at line 1. That's where your qualified tip amount goes. Some older software versions miss this early in the season. If you're using a tax preparer, ask them specifically, did you claim the tip deduction on Schedule 1A? Move 3. If you're not sure whether your occupation qualifies, search for Tipped Occupations list on irs.gov. The list has 68 jobs across 8 industries. It takes 2 minutes to check. Let's recap everything you now know. The no tax on tips provision is a federal income tax deduction, not a full exemption. It lets you deduct up to $25,000 in qualified tips per year. It's available for tax years 2025 through 2028. It phases out above $150,000 for single filers and $300,000 for joint filers. You claim it on Schedule 1A, a brand new IRS form, and it stacks on top of your standard deduction. Your 5-step tip deduction checklist. Verify your occupation, confirm your tips qualify, check your income against the limit, file Schedule 1A, and meet the April 15th deadline. That's the move. Money made simple. If this was useful, you'll want to see how the overtime deduction works. It's a similar structure, but the rules are different and the mistakes people make are even bigger. I'll link it right here.